Well, good afternoon, everyone. My name's Ryan Ovenden. I'm a wealth advisor with Pinnacle Wealth here in Sioux Falls, South Dakota. Welcome to our virtual classroom for today. Thanks for joining us. And we're going to be talking today about the cost of investing. So as we've discussed in previous webinars, one of our core values here at Pinnacle is education. It's through education, professional knowledge, integrity, and a personal touch that we strive to make complex things simple for you. And we want to give you a positive and meaningful experience in society. We want to do that one financial plan at a time. So in the spirit of education and full transparency, let's get talking about fees and why they're so important to you as an investor. So today, what we're going to do is we're going to help you to understand what you're paying for and why you're paying for it when it comes to your investments. We're also going to talk about the correlation between investment value, performance, and expenses, because they are correlated, and typically you get what you pay for in life in every area of life, and it's no different in finances. Finally, we're also going to talk about some questions that you can bring to your financial advisor that will help you to better understand what you're paying for and why, so that you can better establish whether this is something that is worth what you're paying or not, because ultimately in life, everything we invest in, everything we purchase, we want to make sure that we're getting value from that purchase, and our investments are no different. So, without further ado, let's hop right into it. So, why is fee transparency important? The number one reason is that you should know exactly how much a product or service costs before you purchase it, whether it's a financial product or not. And so, that's up to your advisor to disclose all of the fees that they're charging you before you decide to invest with them. But the reality is that most advisors aren't very clear about the fees that they charge. So as we discuss fees, it's important also to remember this one economic concept. Cost is only an issue in the absence of value, right? So it reminds me of a car. You go to car shopping, right? People don't buy the cheapest car generally, and people don't buy the most expensive car generally. Most of the population buys something in between. So what do? We do a cost-benefit analysis before we purchase the car. We want to find something that's a good fit for our needs, but we don't want to pay more than we need to for something that fits our needs, right? So do you buy a car that has 4 doors or 2 doors? Do you buy it electric or gas? Do you buy a car that gets good gas mileage or that has more space in it? Do you buy new or used? 4-wheel drive or 2-wheel drive? Front-wheel drive or rear-wheel drive? Rust or not? All those things are questions that you ask before you purchase a car. For us, we have 6 kids. And so when we went to purchase a car, one of our main values was we want to be able to fit all of our kids in one car so that if we go out on a trip, we don't have to take 2 cars. So that was a huge value to us. That really narrowed down, as you can imagine, our choices especially when you're trying to fit car seats in what kind of a car that we're going to get. So all those things that are things that you evaluate when you're making other purchases in life. But too often we don't evaluate those things, those cost-benefit analysis when it comes to our finances, but we really should. It's the same with our investments. What we need to do is we need to determine the cost that you're willing to pay based on your needs and your wants. So like cars, all investments have different features and different costs associated with those features, and that's what we're going to get into today. So let's make some sense of all of the costs and expenses with your investments. We're going to start with mutual funds. So just like there are many types of cars, there are also many types of investments, and each come with their own set of costs and benefits. Mutual funds are a great way for a person to get some money invested in the stock market, and it's no wonder because almost 59 million Americans own mutual funds. Why do so many Americans own mutual funds? Because mutual funds are generally about the only thing you can invest in inside of a 401k, and that's where most Americans have the majority of their investment dollars. Simply put, a mutual fund is a pool of investors that put their money together to buy a pool of investments at a reduced cost to the investors, right? It's all of us getting our money together and saying, hey, we want to buy that thing, but we want to buy it for cheaper because we have a bunch of money put together. That's what a mutual fund is. It's a fund that has a number of people that have come together to be able to fund it, okay? It allows the pool of investors to pay a professional as well to choose which companies that mutual fund wants to invest in. And there are all sorts of mutual funds out there. Mutual funds are generally your only option to invest in a 401k, and 401ks are where most Americans have most of their dollars, which we discussed earlier. But although they are simple and a very good option, it can also be difficult to know exactly how much you're paying these experts to invest your money. There are numerous types of mutual funds and numerous types of fees related to those funds. A few different types of mutual funds are front-end sales load funds. So some advisors utilize these front-end sales load funds, and they will charge up to 5.75% of your initial investment as a sales commission, and that goes to pay the advisor. So you pay up front, and then you don't pay again, but you have an expense ratio on the funds, which we'll get into later, and that is an ongoing fee that goes to American Funds or Franklin Templeton or whichever mutual fund company you choose. These are typically called A shares, okay? Then there are back-end loaded funds that charge less money up front than A shares, let's say 1%, but more on the back end year after year after year. So you pay a higher expense ratio year after year, but a lower upfront sales charge. These are typically called C shares. In addition, there can be fees if you pull your dollars out too early or if you decide to trade to another mutual fund company or another mutual fund. There's also annual maintenance fees at nearly every mutual fund provider, and there can be additional purchasing fees as well. Finally, there's what's called an expense ratio, which is the fee that the mutual fund company charges anyone who invests in their fund. Typically, you're going to pay a higher expense ratio on things on aggressive accounts that are overseas, and you're going to pay your lowest expense ratios on mutual funds that are U.S. bonds. They're lower on the aggressive list, so they're a little more conservative. Things like money markets, they have very low expense ratios as well. So, depending on what your investment needs are, if you want to grow your dollars more, you're going to generally pay more on a growth portfolio than you are on, let's say, a portfolio during your retirement that you just want income from. Another option to invest in are called ETFs. ETFs and index funds have been touted as the cheapest investments when it comes to expenses, and they are. They're very reasonable. They save the investor money because they don't have to hire as much management to pick stocks inside the portfolio. Instead, these ETFs or index funds typically just track an indice or a benchmark, such as the S&P 500 or the Russell 2000. Even though they're low cost, though, there are no free lunches for anyone who wants to invest money in the stock market. There's a cost to investing everywhere. It's just a matter of whether the cost is transparent to you or not. So how many of you honestly know how much you're paying on your investments in your 401k? Very, very few people know exactly how much they're paying. And if they do know, basically they know the expense ratio on the investment funds. They're not aware of all the additional fees that a 401k provider is charging them, and that it's being dispersed throughout the entire company. So there are fees that we know about and fees that we don't know about. Our goal today is to educate you to be able to find out what those fees are, so you can make a better decision on where to invest your dollars. But all of these have their place. It's just a matter of finding out what the best place is for you. What kind of a car do you want to drive? What are your purposes there? That's what we're trying to find in your investments. And so sometimes it just takes having somebody who knows what they're doing to walk you through the different variables and help you to really find your best fit. Another option are annuities. An annuity is actually a contract between an investor and an insurance company. So an annuity is not an investment. An annuity has investments inside of it. And so you basically give your money to an insurance company, and in return, they will give you some sort of a benefit back. There are typically three types of annuities to an investor. The first is called a fixed annuity. Imagine a fixed annuity is a little bit like a CD product in a bank, okay? They're going to give you a guaranteed rate. It's going to not be a very high rate. In today's world, we're looking at probably somewhere in that 2, 3, 4% range, but they're going to guarantee you that rate. They're going to guarantee you that your money won't go down in value as long as that company stays afloat. And so there are no free lunches. There are no guarantees, even if an insurance company guarantees that they're going to give you a rate. you still have to make sure that that insurance company is in a reasonable position and will be around to make those payments back to you. Because if that insurance company goes under, there's still a chance that you might lose your money, even if it's guaranteed. So really in life and in investments, there aren't any 100% guarantees, even on a fixed product. Okay. But a fixed annuity is a lot like a CD. Okay, so you're going to buy in at a fixed rate, and you're not going to get anything higher than that. Really good on the downside risk side, but not so good in any sort of an inflationary period, because if inflation rises, your fixed rate's not going to rise. You locked in at that fixed rate, and 20 years from now, it's going to be the same. A variable annuity is your second kind. It's like a mutual fund. So think of that as your mutual fund. Generally, these are sold because of the riders that you can purchase with a guaranteed income rider or some sort of growth rider, or because people just want to invest in something that grows tax deferred. And so these are used widely throughout the industry. We'll get into the specifics on these in a minute. The third type is index funds or index annuities. These follow an indice, but they have a cap on the gain and a limit on your losses. So, for example, you might purchase an S&P 500 index annuity. It might have an 8% cap on your growth. So if the S&P does 30%, you only get 8%. But on the downside, it might have a 1% guaranteed growth. So if the S&P 500 loses 50%, you still get 1% guaranteed growth on that account. Now, again, this is all based on the health of the insurance company that you choose to sign this annuity contract with. So you want to make sure that you're getting a very highly rated insurance company before you would move forward with any product like this. And these products aren't the right fit for everyone. Index annuities are also sometimes have the highest costs associated with them as well. And so if you ever need your money out for a reason other than lifetime income, you may find that it's a significantly more expensive product than some of the others you could have chosen. So annuity fees, there are all kinds of fees within annuities, okay? This is what insurance companies do. They charge you a mortality and expense rate, an M&E charge. Typically, those are about 1.25% per year. Then they will add administrative fees, underlying sub-account fees, fees on, fees for other things, fees for penalties for pulling the money out early. Typically, these things are going to have a 5 to 10 year surrender charge. But basically, with an annuity plus some mutual funds, you're probably going to be paying in that 3% or more range, sometimes closer to 4, 5, 6%, just depending on the carrier that you go with and what you're trying to do. Now, for some people, paying that expense is worth it to have some guarantees and to feel some of that safety. For others, they say, hey, if I want to grow my money long term, I know that that's going to be too much of a drag, so that's not a good fit for me. So it's really important to talk with an advisor who is unbiased, who has your best interest in mind, who's going to walk you through the pros and cons of each of these and help you really decide which of these are best for you. Another option for investments are REITs, real estate investment trusts. They tend to have higher minimums to get in, especially in the private sector, non-traded sector. You typically have to be an accredited investor to get into some of these, and they also struggle during periods of high inflation. They're a very interesting product, though. They allow you to invest in real estate without having to go out and buy the house or buy the apartment complex. You get to it's basically a mutual fund that you and thousands or millions of other investors put your $100 or $1,000 into this fund, and you get to own portions of an apartment complex or a mall like the Empire Mall in Sioux Falls. Some of those are offered as REITs, and companies buy in, and their goal is to buy a REIT that has a really high percentage of people who are renting space in that REIT. And so there's no free lunch here. These are not guaranteed products. They can go up and they can go down just like the stock market does. But it's a good chance for the average Joe to be able to get in and get some real estate into their portfolio when it comes to the mutual fund based REITs. So there are mutual funds that specialize in these real estate investment trusts or REITs. They typically have an expense ratio of around 0.5%, but they can be up to as high as 3%. The median real estate fund costs a little over 1%. So just to give you an idea, that's what you're going to be paying if you want to invest in a REIT. Not a bad idea for somebody who doesn't want to go out of their way to actually manage a property, but wants to own some hard real estate. Okay. So how do you walk through all of these options? I mean, with all of these options to invest in, how do you even decide what to invest in, or where do you even start? When we look at fees, for example, fees, ETFs and index funds are going to be the cheapest on the fee side, where annuities and REITs are going to be the most expensive, upwards of 3 to 7%. Liquidity needs. ETFs and index funds and mutual funds are very liquid. Typically, you're going to be able to access your money within 5 to 10 business days of needing that money. Typically, annuities are going to have surrender charges and fees, maybe in that 5 to 10 year range, like we discussed earlier. I've seen annuities that have a 10-year surrender fee, so you might pay 10% of your total that you've invested if you pull that money out in the first year, and then it goes down from there every year until you have no more surrender charge. And so you really have to be cautious of these underlying fees that you don't realize are there. So you got to work with an advisor that's going to share these things with you. It's really hard to navigate all of the different products that are out there and find out what the best fit is for you. Other things that are a big issue for people who are trying to invest money, guarantees. Some people want guarantees. So when you look at those, annuities and REITs tend to have the best guarantees, or 99.9% guaranteed, because like I said, nothing is guaranteed 100%. In this world, other than death and taxes, right? But with ETFs and mutual funds, they don't have any guarantees. So if you're looking for a guarantee and you don't want to take on any market risk, you are going to have to pay extra getting into some of these annuities and these REITs. On the tax side, taxes are a huge issue for people who are investing. ETFs are extremely tax efficient. Their mutual funds are also tax efficient. They can be used for tax harvesting, where we can sell losses at the end of the year. We can gift gains instead of gifting cash. There are lots of different strategies we can use for ETFs and mutual funds that help us to be more tax efficient. REITs tend to be very tax efficient as well because they tend to pay income as a dividend. But annuities can be pretty tax inefficient when you start to take money from them, because you're going to pay taxes on some of the growth when you pull the money out, and then you won't pay taxes on a portion that would be considered the principal that you've put in. And so, are taxes a big issue for you? That's a big part of choosing what is the best product for you. Just like buying a car, there are all these factors, all these features to take into consideration before you make an investment decision. And knowing how much these things are going to cost and how much benefit they're going to give you is just a part of being a good steward of the dollars that you've been given. So we would encourage you to be a good steward and ask yourself the question, where the heck do I go for help? How do I even weigh my options? There are a lot of options out there for where to go for help as well. The industry has really moved in the direction of creating some DIY options to help investors to save money, because expenses are an issue. We want to make sure that any cost that we're paying is providing us value in return. And so the industry has created what are called Robo Advisors. So many financial institutions have offered Robo Advisors. They're online, they're do-it-yourself financial platforms. They have a lower cost structure, so they've got somebody sitting in an office somewhere, and they can generally give you some decent advice on where to invest your dollars. But, and this is a big but, is the cost savings worth what you lose in having a trustworthy human who actually knows you and knows investments and can help you navigate toward the best option for what you need and want? I can't stress that enough. Your advisor, if your advisor doesn't know you, how can they give you advice on what to do with what you have? And so basically what you're doing is it's a little bit like online medicine. I mean, do you want a doctor who you're going to be able to go into, sit face to face with, who knows your kids, who knows your family, who wants what's best for you, giving you advice on what to do with the health of yourself and your children, or are you willing to just trust anybody with an MD over the internet? And so that's kind of where we're at right now in the financial industry. Do you want that personalized touch, or are you okay paying a lot less for a lot less value? And in some cases, it's not even a lot less. It just kind of depends on what they're offering and how they go about getting paid. So I will give you some questions to give to the Robo Advisor or any other advisor in just a few minutes that will help you to determine who's going to be a best fit for you. There's also what are called brokerage firms. So many investors choose to work with brokerage representatives that are affiliated with large, well-known firms. And I won't name names here, but these are some factors to consider. Brokerage firms operate by what's called a suitability standard. So what they have to do is they have to determine what is going to be a suitable investment for you. They don't operate based on a fiduciary standard. The suitability standard is really based on how much money you have. And the fiduciary standard is based on us giving you advice based on what is in your best interest, not theirs. A lot of times what you'll see with brokerage firms is it becomes about product sales, and you will feel like you're being sold to. Many brokers deal in this world of calling their clients on a monthly basis or every other month to try to get you to move from one thing to the next. All those things generate fees for the broker. And you know what? They may be suitable for you as an investment, but it's not in your best interest to be turning over your investments on a regular basis. And so it sets up this model of brokers being in a sales position instead of a service position. And we want to flip that upside down. So a big difference is when you work with an advisor is not going to be in that position. They're more in a service position than a sales position. So advisory fees. Let's talk about advisory fees here. Firms offering advisory services vary greatly in size and scope, from very large investment banking and brokerage firms to boutique and independent wealth management firms. That's what we are here at Pinnacle Wealth. We are an independent wealth management firm. Advisory firms also all operate differently. So there are kind of two structures in how they get paid and how they charge fees. The number one is fee only. So you may run into an advisor who's fee only. Typically, they will charge an hourly planning fee, or they will charge some sort of an annual retainer where you are going to write a check out of your checking account to pay them for their services. And typically, you aren't going to pay for the investments that they're providing for you as well. There's a second model called the fee-based model, and that model is where they will charge you typically an asset management fee, or they'll charge you a commission on the investments that they're recommending to you. Typically, advisory fees are going to vary. They're going to be anywhere between 0.5% and maybe 2%, and are given to you up front so that you know exactly what you're paying for. So an advisory fee is going to be fully transparent. You're going to know it's a percentage of assets that you manage, or you can ask what the commission would be. A brokerage relationship, it's going to be commissions, and you're not going to have any idea what you're paying. So, along that lines, brokerage versus advisory fees, it's really hard to compare and contrast the two because it's so hard to figure out exactly what those fees are inside of a brokerage account. Due to the number of variables involved, it can be really difficult to compare these two. Expenses vary based on the size of your account, product mix, the trading frequency, et cetera, et cetera. Some will have administrative costs, some won't. And then also your service preferences. So all of those things are taken into account when you work with an advisor versus a broker. As advisors, we are going to service our clients first, and we are going to be fully transparent about our fees. And so you know exactly what you're paying and exactly what you're getting in return. So what are the advantages of an advisory relationship? The main advantage, and I'll let you read this for yourself here, but the main advantage is that advisors focus on an individual plan. We believe that you shouldn't be sold a product, but that you should have a plan for your money and for your life. And that plan should match your money with your goals and your dreams. So our job as financial advisors is to take you through a planning process that leads you to even a better understanding of some clear goals and objectives for what you want to do with your life. And let's make your money match your goals and your dreams in life, and not the other way around. Too many people live their entire lives saying, I can't afford to do what I've been created to do. And we want to say, no, you've been created for a purpose. Let's figure out how to fund that purpose, and let's figure out how to do that efficiently and being as good a stewards as we can possibly be with all the time and the talents and the resources we've been given. That's what we do as financial advisors. We're in this for the relationship, and we're in this for the long term. We're not going to sell you a product and then disappear. Financial advisors also operate as fiduciaries. This means that in a fiduciary capacity, we're held to the industry's highest standards in transparency and integrity. So we legally have to do what's in your best interest 100% of the time, or we are liable for the advice that we've given that may be contrary to what is in your best interest. So if your current advisor isn't helping you in these ways, we want you to give us a call. Communication is the key to operating as a financial advisor and having an advisory relationship, right? As opposed to a brokerage relationship or a robo advisor or a life insurance or an insurance salesman type of relationship. We want to provide you with regular trade notifications, so we do that on a regular basis. Anytime there's a trade in your portfolio, you will know about it. Weekly financial commentary, monthly newsletters, quarterly outlooks, annual reviews are an absolute necessity. Knowing what's happening in your life so that we can make changes based on that is extremely important. Making sure we're giving you the facts on any of the investments that we're going to have you invested in is extremely important. And making sure that we're getting you insightful educational materials like this, like we hope this would be for you as well. So if your advisor isn't helping you with this, give us a call. We would love to talk with you. So at Pinnacle, we want you to be able to ask the right questions when you're approaching your advisor, and that includes us too, okay? So do your research when selecting an investment professional. Ask these questions. How do you get paid? Do you receive commission-based or fee-based compensations? If commissions, how are the commissions determined? Are you compensated in other ways outside of that? Do you have any sort of arrangements that other people are getting paid by referring people to you? Do you have any choice in how I pay you? Or do I have any choice in how I pay you as my advisor? Can you provide a fee schedule listing all the fees that will be charged for your investments and the maintenance of my account? Do you charge any transaction or advisory fees? Can I pay lower fees if I open more than one account? Do I need to keep a minimum account balance to avoid certain fees? So all these are great questions that will help you to narrow down exactly how much you're paying and what you're getting in return. At Pinnacle, we don't have any minimums for account sizes. We believe that everyone should have a plan for their money, not just be in a bunch of products. And most people, their financial plan involves 15 different products at 15 different places. Most of us have 2 or 3 old 401ks floating around out there that we still get statements from, but nobody's really watching it. Most of us have, life insurance here and health insurance there and, long-term care insurance here, and everything's just kind of all over the place. And there isn't one quarterback looking over the entire plan. And that's exactly what we do here. So at Pinnacle Wealth, we believe in charging a fee for financial plans and giving you a plan that is so valuable to you that you say that's all that you charge. And so that's our goal in every one of our relationships. So we believe that everyone should have a plan for their money, not just a product. If you need an individual plan, you want to work with a firm that's totally transparent when it comes to fees, we'd be honored if you gave us a call or shoot us an email. We'd love to hear your story. We'd love to help you develop a plan that creates peace in your life, that creates confidence in your life and your finances, and that gives you a greater sense of purpose for everything that you're doing in this life, and that creates more value for you than what we cost you in what we charge. So if those things are important to you, give us a call at Pinnacle Wealth here. Our phone number is 605-271-6023, or shoot us an email, info@pinnaclewealth.com. Again, phone number 605-271-6023 and info@pinnaclewealth.com. Please contact us, and we would love to hear from you and to start this journey with you. Have a great day. God bless.